Hey, Market Chameleons, thanks for joining us for tonight's webinar. We're about to go live in less than a minute. You're only on YouTube viewing us right now. Hey, Market Chameleons, thanks for joining us. Whoa, sorry about that. Webinar. Sorry, Dima, technical issues.
No problem.
That was YouTube Live. How's everyone doing on YouTube Live? Everyone good? Thanks for joining us. All right, it's 6 o'clock. Let's start the webinar, Dima.
Thanks, everyone. Okay, so we're going to begin, and Will is going to put up a disclaimer really quickly here. Just keep in mind, everyone, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional advice, then contact your broker or your registered investment advisor. They should be able to help you with any questions. So there's that disclaimer here. Let's leave it up for as people are joining us. Will, let's just keep it up there for.
Yeah. So for everyone who's new, we are also running the webinar on Zoom. So if you're on YouTube right now, I'll put a link to the Zoom meeting. We've got about 33 people in the Zoom meeting right now. All questions in the Q&A on the Zoom. You can put questions in the YouTube chat and I will get them to Dmitry. Dmitry, do you want to wait to the end for questions or do you want to kind of hit them as we go? What's your thought?
Yeah, that's fine. You could, if you see questions popping up, we could hit them as we go, but I'm going to leave room for the end, enough time so we could start going through the questions. And if you guys do have questions, put it up in the chat. In that chat, is that right, Will? It's in the chat, or
yep, well, you can either chat it in or the Q&A on Zoom. But on YouTube Live, definitely put in the chat. That's the one place to do it. Now, if you're new to Market Chameleon and Dmitry and I, we also do a morning show. Every morning, we start a little bit before 9. Always a lot of interest and talk on the day's trading topics. Again, if you can make sure everyone can hear us all right, the sound sounds good, please let me know you can hear us. And with that, D, everyone looks good. You ready?
Yep. All right, let's go. So I'm going to start. I'm going to share my screen here. And for today's discussion, we're going to look at payout diagrams. And before this, we started doing like a series of webinars. We talked about an options chain, how we could look at where the call prices are, the put prices. We talked about implied volatility, expirations. And today, really, we're going to go and take a look at a payout diagram. And these are what an option or an option strategy looks like, the profit and losses at expiration, depending where the stock lands. So you're going to see a diagram, and depending where it lands, you'll see where it's profitable, where it's unprofitable. And it's very important to traders, especially when you're starting to do strategies or combinations of different options. And you want to, and if you have a certain outlook, you just want to make sure that that diagram, it fits into your outlook. So we'll go over couple different strategies. We'll do some bullish ones, bearish ones. We'll do some directional neutral trades, and obviously we'll take any questions that you guys have. One interesting question we probably should have asked Will is, what are people mostly beginners here, intermediate or advanced? If we still have time to put that up, that'll be great, just to know what type of strategies we could start looking at as we do this demonstration. So here we have SPY, and this is the SPY options chain here. And the market's closed here. I have the expirations here to my left, and I just went to the October 23rd expiration with 29 trading days to go. This is the options chain with all the different prices for the calls, different prices for the puts. And the questions we want to really know is, if I buy this call, sell this call, buy this put, sell, or any combination, where are my break-even points? Where do I make money? Where do I lose money at expiration? So a simple payout diagram would be the following. Let's say in SPY, I'm looking at the 343 strike. So that's 1.7% away from the closing price. So the 343, stock closed at 338.66 around here on this snapshot. So this is an upside call, 1.7% away. And on top of that, here's what the prices are. $6.58 bid, $6.66 sends ask on the offer. So let's assume if we're buying this call, I'm going to click on that offer. So, and it just populates a ticket like this: buying October 23rd expiration call, the 343 strike for $6.66. So it's just right here. It's just copying that call over here. We could see it here. So let's just stick to this one call. I'm going to load the strategy, and it's going to draw me a payout diagram at expiration. So this is a simple one, right? So at expiration, if the stock is right here, which is 338.66, this option that we paid $6.66, it's going to expire worthless. So see here, current spot price, that's where we lose money, right? We lost it if it expires worthless and we paid $6.66, that's loss. If the stock goes down, that option is worthless. We lose $6.66. Okay. Now, as the stock is going up, because obviously we need it above 343 for it to have any kind of value at expiration. Anything below, it's worthless. As it's going up, we start making some of it back above $3.40. As it goes up above $343, then that option starts to have some value, but it has to get above. It has to cover the price that we bought it for, $6.66, right? So it has to get above 349.66, which is our break even, right? Our break even. Once it gets above that, then that option becomes profitable. And that's what this payout diagram is showing us, where we're breaking even, where we're losing money, and where we're making money. So if you're long a call, simply as the stock goes higher and higher and higher, once you're above your break even, it acts like stock and it just becomes profitable one for one with the stock, right? So that's a very simple call buying strategy. And before we get into, if everybody's okay with this diagram, then we're going to start doing combinations of options. And Will, let me know if you have any questions.
I will.
Yeah. Another thing here, before we move on, we might as well just take a look at some of these other features. So here it tells us that we didn't create a strategy. This is just one call buying. We see this is the bid. This is the offer of the option. This is the midpoint, $6.62. So one thing, keep in mind that you want to try to get your executions as close to the midpoint of the market as possible, because that midpoint, that's kind of considered the market fair value at that moment, right? So the more you pay above the midpoint, or the more you move away from that midpoint, that's considered like your fee to the market makers to get your execution. Okay. So if you're paying $6.66, the midpoint is 6.62, that's 4 cents above that midpoint. So that's what you're paying to get that execution. That's like 4 cents to the market maker or to the market. This is SPY, so SPY tends to be much narrower bid-ask spreads, but once you move it to other illiquid stocks, you're going to see these spreads widen out. So guys, keep that in mind when you're trading. This here tells us the delta of the option, the gamma and the vega. Maybe we'll get a little bit into this. This is the theta. So the theta is right here, this is $10.80. So if you paid $666, $10.80. If nothing happens and the stock just sits here, the implied volatility stays the same, then you're expected to lose $10.80 in decay. So this option, nothing happens in one day, it's going to lose $10.80 according to the Black-Scholes model, if nothing else happens. So that's your theta. Your delta is that's what this option is expected to change by for a $1 move in the stock price. So stock price moves up $1. This option is expected to increase by 41.5 cents. If the stock moves down $1, then this option is going to decrease, or expected to decrease, by 41.5 cents. That's what your delta is telling you. So it's your risk in the option for a $1 move in the stock price. Again, that's keeping everything else the same. Implied volatility doesn't change. If this happens, the next move is up or down $1. That's what our delta is telling us right here. Vega, that's the implied volatility risk. So if implied volatility moves down 1 click, right, we're losing 45 cents. Up 1 click, we're making 45 cents because we're long Vega here. And this is your interest rate risk. So we might take a look at some of these as we're doing more combinations, but that's really quickly, that's what all this is telling us over here.
Hey,
Yes.
DC,
Yep.
I'm going to launch the poll real quick. That way we get an idea of the audience. We have over 50 people right now on the Zoom.
Okay.
So,
Awesome.
the question is, it's your experience level, beginner, intermediate, expert, or are you Dmitry? I know I'm not Dmitry. So there may be a few. If Jake's on, he may be a Dmitry. He's one of the great chameleons. Mike.
Yeah.
Right now, Dima, wow, we've had over 30 people polled. It's about 50-50 and 5% experts.
Okay. So 50 begin. So
47,
50,
47, and 5%.
Okay. Okay.
And only
Awesome.
one Dmitry.
Okay. So I'm going to try to keep it a little bit like simpler to intermediate. And if there's questions on things that I'm doing, just let me know, Will.
All right.
We'll do. Now we also have over here, we have a couple other tools, and this is a payout diagram at expiration. Now you might want to say, well, I'm going to just scroll up here. So there's 29 trading days to expiration, and maybe you're not intending to hold it necessarily to the entire 29 trading days, but to a certain date, you have an expectation up to a certain date. Maybe you think the implied volatility will go up or some kind of move will happen. And you might want to just draw what does this look like prior to expiration, right? Prior. So at expiration, it's kind of easier to draw out because either the option is going to be out of the money and it's going to be completely worthless, right? Or it's going to have some kind of value depending how far it gets above that strike price. So if it's very easy, right, to say, well, if the strike price is 343, if the stock closes at 344, this option will be worth $1. If the stock closes at 345, then this option will be worth $2. It'll be the difference between the stock price and the strike price once it's above here. So that's pretty easy to determine at expiration. That's why that's why the payout diagram at expiration is pretty easy. But what if we want to kind of know prior to expiration? Well, prior to expiration, it will depend what the implied volatility is of the options. So it's still going to have premium. It's not completely at parity. Hey, Will, did we lose you?
Yeah, you lost me for a sec, buddy. Sorry.
So prior to expiration, it's a little bit more difficult and trickier to figure out, well, what is this option going to be worth if the expiration, what did I say, October 23rd? Well, what is this option going to be worth September 28th, for example? So on September 28th, it's not as clear cut, and you got to start making assumptions. Well, it depends where the implied volatility is on that date. Now we'll know that it'll have less days to expiration. So if we run the model, we run the Black-Scholes model, we'll rerun it, and we know that instead of 29 days left to expiration, it'll have 19 days left or whatever it is. So though that we know, but we don't know what the implied volatility of it is. So initially, let's just assume that the implied volatility will remain exactly the same. So if it's exactly the same, this option will decay. And depending where the stock is, this blue line will kind of tell you what your estimated profit and loss will be compared to expiration. So the blue line is on September 28th, and the and that's comparing it to that original payout diagram at expiration. Now, what if that's no change implied volatility. What if we think the implied volatility will move? Maybe we think that the options are priced premium wise a little low. What if we think the implied volatility will move up? So then, depending on what you think the implied volatility will be, you could change it over here. So let's just say you think that the implied volatility will be higher because we're getting closer to expiration. Maybe, I mean, closer, let's say we're getting closer to the elections, and maybe as you get closer to the elections, there's more uncertainty. Maybe there's like, you know, from both sides, more dirt coming out. So, you know, volatility increases. So, and I don't know if this is happening, I'm just making up a scenario. And realistically, maybe we think the volatility will be 25. So I'm going to change that to 25, right? I'm going to change it to 25. I'm going to reload that strategy now with 25, the new implied volatility 25. And let's go again, September 28th. It's going to draw. So now here's the new line, right? So that's the new line depending where the stock is, assuming that the implied volatility will be higher, and it's going to be at 25 compared to today's 29. Now we could go the other way as well. What if we think, well, the implied volatility right now is high, people are nervous, and then there's going to be more certainty as we're getting closer to the election, and assuming that this implied volatility is reacting to it. And let's just say instead of 19, it comes down to 15. So let's enter in 15 here. I'm going to load that strategy now. And again, I could pick any date here. Let's stick with September 28th. September 28th. And now that's blue line. That's the estimated what you'll make or lose based on 15 implied volatility and where that stock lands. So those are really quick ways to try to visualize a different payout diagram, changing the scenarios, right? And it's important because you want to know, do these line up with my expectations for the future? Because if you think, well, the stock is going to be right here and implied volatility will be lower, then this strategy won't make sense, because all around here, right, you will be losing money. If you think it's going to be up here, then the strategy is worth a look, because the strategy will be profitable, making all these other assumptions. So hopefully that makes sense really quickly from the payout diagram perspective on this one call.
Hey, D, we are getting a question. You were maybe going to go for it. I just wanted to make sure Christine gets heard. She's asking, can you give an example of a vertical, either put vertical or a call vertical?
Yeah. So did she have a preference?
Well, she did say call first. She did say put first. So let's do a put.
Okay. Or you know what? I'll do both. Why don't we do this? Let's do both. So call vertical. So that's a spread. You're buying one option, selling a different option, right? So let's take a look at that. So I'm going to buy, let's buy, and you have to pick the strike. So I'm just going to pick some strikes here. Let's say I buy the 337 call, right? In the same expiration. We're still in October 23rd expiration. So here we go, buying the October 23rd expiration call to 337,998. So that's that offer here. And let's say I come out into finance that I'm going to sell in a call strike above. So let's say the 340 call, I'm going to sell it for $8.16 over here. So now you see here, I have two legs to this strategy. Buying the October 23rd call 337 for $9.98, selling the October 23rd call expiration, the 340 strike, for $8.16. Let's load that strategy and see what that looks like at expiration. So this is what it looks like at expiration. Okay. So we're paying $1.82, right? Because that's the difference between these strikes. You're paying $9.98, selling $8.16. So on net, you're paying $1.82. This is your midpoint, $1.75. This is $1.67 bid for the spread, $1.82 offer, midpoint 175. Remember, we talked about that midpoint. Again, these are your Greeks for this spread. And let's take a look what this spread looks like. So if the stock remains right here at 338.66, so 338.66, that's close to your break even. I think this is a little bit right below your break even. So you're close here. So you need 338.82, right? $1.82 plus 337 to break even. So it's a little bit below break even. If it moves up and it goes above this long strike, 340. So over here, once it goes up, all here, then it's a profit. So over there, you make 118 bucks on this spread, right? So, which is you paid $182 and your profit was $118. So that's a pretty good return, right? On 182, $118 return. But if the stock goes the other way and keeps falling and goes right below this 337 strike over here, you're stopped out and you lose whatever you paid for it. So if it keeps going lower, you're stopped out, and that's your loss of $1.82. So this is what a vertical call spread would look like. Buying one call, selling another call. It was we could do now put spread if that's her answers, at least on a call spread. If that answers a question, let's go to a put spread. So on a put spread, and it depends. Sorry, if you're buying or selling the put spread, but let's take it from the perspective of selling a put spread, like a credit put spread. So I'm selling one put. Let's do the 336 put, and I'm going to buy another put to hedge it. Let's do the 333 put. Okay, so I'm selling the 336 put, buying the 333 put. So over here, selling 336 put for $9.07, buying the 333 put for $8.13. Let's run that strategy. So over here, a credit of 94 cents. We see the midpoint 102. Again, this looks very similar to a call spread, right? The stock goes up, is above the 336 strike, right? You make this 94 cents. The stock goes down and it keeps going down, then you could lose whatever the difference is between these strikes, $3 plus minus whatever you collected, 94 cents. So that's really quickly what an out of the money credit put spread would look like. So in this scenario, let's take a look. If the spot price remains the same, so right now stock's 338.66. If it remains the same right here at expiration, then you keep that 94 cents. That's what it's telling me. If the stock goes up, then you keep that 94 cents credit. If it goes down over here and crashes out below that low strike, 333, you're stopped out, and it's a loss of $206. So that's what the payout diagram looks like in this particular spread. So we did a vertical call spread, vertical put spread. Does that help answer her question?
She said thank you before you were done.
Okay. All right, perfect. So let's take a look at a couple other strategies. Are there any other strategies people are asking about?
Well, we haven't heard any other strategies, but I see Mike is on the YouTube, and this morning we didn't get to his question on Oracle. I don't know if you just want to walk through a strategy in Oracle.
Okay, so was that because of earnings?
It was something he was interested in. It could have been earnings.
I don't remember if it was. Probably not.
I think it was basically it was on the news. He was maybe looking at how do you play the long side with this TikTok news. So it wasn't an earnings issue. I think this morning on this morning show we were discussing that it looks like Oracle's the winner of this TikTok lottery.
Right. Okay. So there are lots of different strategies to play long side, the short side, or even the volatility, and it does not in either direction. So let's take a look at Oracle. Let's take a look at a straddle. So a straddle is buying the call, right? So right here, I'm going to go to the 59.5 strike, buying the call. That's over here, and let's buy the put. So now, so this is what I did on October 2nd, buying the call 59.5 strike for $2.08. Then I'm buying the put 59.5 strike for $1.96. Let's see what that looks like. So here, this is what the strategy payout looks like, and this is straddle. So basically, we're paying $4.04, right? Because we're buying both the call and the put, $4.04. We see here the midpoint 384. Again, keep that in mind. That's 20 cents, much wider than we just seen it. So you want to try to get it next to that midpoint. We see there's a slight delta to it, not that much. A gamma, there's a theta because we're buying both options. So these options are going to decay every day. And now let's take a look what this is saying. Now, if the stock at expiration is right at 59.5, so 59.5, but where both these strikes are, that's where our max loss is. We're basically going to lose every, both of these options will expire worthless, and we lost everything. So obviously, according to this graph, we needed to move away in either direction, either up after we get through this break even, we start making money, or down in this direction, and then we'll make money. And the reason is that as you're moving up, right, your put will become worthless, but your call will start making money, and it'll offset the put. And if it keeps going higher and higher and higher, it'll become profitable. So if we're paying $4.04, we needed to move more than $4.04 in either direction, because one of these options will become zero. So the other option has to be worth more than $4.04 for it to be profitable, right? So if it moves up in the up, it'll go, more than $4.04 above the 59.5 strike, and then it becomes profitable. It keeps going and going and going. Or if it moves down, has to move down more than $4.04, and that's your break even, and then it keeps going and going and going. So the put will keep making more and more money. The calls will be worthless on this side. On this side, the call will keep making more and more money, and the puts will be worthless. So that's your straddle. So in either direction, it's got to move, and these are your break even points over here at expiration. Another thing you could do is say, well, this is a lot for it to move. I think it's going to move, but it's a lot. I don't think it's going to move that much. So maybe if you could finance it by selling the outer strikes, right? So maybe you think it's going to move, but I don't think it'll move past. If it goes up, it's not going to move that much more above 63. So I'm going to sell that 63 call. And if it moves down, and I'm just going to use the same distance. So if it moves down, I don't think it'll move down much below 57. So I'm going to sell 57 put, right? So I don't think it'll go down below that. So look what I did. I bought this, the at the money call, bought the at the money put to help finance some of it. I sold an out of the money put, and then I sold an out of the money call. So let's run that strategy. And this is called a butterfly. And this is why. Oops,
Looks like you got a broken wing there.
Did I do a broken wing? So I went too far. What did I do here? 3.5.
While D's figuring out one of his wings, everyone on YouTube, well, listen, everyone even on Zoom on the chat, if you haven't checked out our YouTube channel, videos are being posted on all the time. If you are a subscriber to the channel, you get alerted to those new posts. And also, if you're on YouTube right now, I know Mike is on Hot Potato Traders back in the house. We haven't seen him in a bunch of mornings. He's been working hard, helping people out. A thumb up is always nice.
So let me undo this one. What did I do? 57. I should have gone what, the 56, like that. So here's it looks like a butterfly with wings, right? Here are the wings out here, and so it looks kind of like a butterfly. So here we still needed to move, but not as much. So you could see here that what we did was, because we financed some of it, now we didn't pay as much, right? From 404, now we're paying $2.78. Again, midpoint 245. But at the same time, we maxed out our gains because we don't think it's going to move that far beyond. We don't think it's going to move to infinity to the upside or to zero to the downside, that it's going to move, but then it's going to settle somewhere around here. So this is the butterfly. So still, if the stock closes at exactly 59.5, that's going to be our max loss, because all the options will be worthless, right? The calls, the puts, all of them will be worthless. So we paid $2.78. We lost that. If it starts moving away from this strike, 59.5, it goes. We start making money here. But since we sold the call, 63 call, we maxed out our gains. And we sold the 56 put, we maxed out our gains here. So what we did was we made a trade-off. It doesn't need to move as much. We paid less, but we also capped our potential profits. And that depends on your outlook, because if you think it'll continue moving, then you might want to go further out with the wings. Maybe you go, to 65 and 53, something like that. This way you'll make higher profit. Did I do that wrong? What was it? 54 maybe.
Well, this is the great thing, is you can work around the trades to kind of get the fit you want.
Right. So here it is. So now, what I did paid a little bit more, but my potential profit is higher as well if it keeps moving. So that's what basically what I'm doing here, is playing around with the different strikes, trying to fit that strategy based on my potential outlook and where I think that the stock might be at expiration. So that's what a butterfly would look like. Did Mike post what he wanted to see?
No, that was why he was asking the question.
Okay.
He was asking it about Oracle, and do you
Okay.
I mean, he wasn't bullish or bearish. He was just asking to take a look at it this morning. I
Okay.
see we do have. He's actually on the Zoom, Melville,
Okay.
but I also see him on the chat. I know he emails quite a bit.
Okay.
He's asking about when you put in a when you build a trade here.
Yeah.
There's no way to see the win rate of that trade. The only place win rates are that
Sure.
data is driven is in the screener. Am I right? Or
no, you can see it over here in the
right.
distribution, right? So you could see it over here, the win rate and the theoretical value.
Well, there you go, Melvin.
And right, so I did want to just kind of focus on the payout diagram over here. So this way people get used to that, and just do the theoretical value and the win rate
on another show.
Yeah, just because it'll get confusing, especially we have like half beginners, half intermediate here, and we've done those shows on the theoretical values as well. But just keep it consistent on the payout diagram. Do you have any other questions on the?
Well, you could map out. Mike did a trade today in Oracle. He did the 58.5, 60.5. I'm assuming it was front month put spread. Vertical put spread today in Oracle.
Which
expiring on Friday. It's expiring this Friday.
All right, so he did the 58.5,
60.5 vertical credit put spread today.
Credit put spread. So 60.5. Here we go, 58.5. So let's just take a look at it over here. So this is what it looks like at expiration based on closing prices. So $1.03 credit, midpoint $1.12. If the stock continues to go higher by you know, September 18th expiration, right? At expiration, you know, if it's over here above that 60.5 strike or higher, that's then you keep that entire credit of $1.03. Okay, if it sits here, that looks like still a little bit of a profit here, because you collect 103 and the stock's 59.53, so that's a little bit of a profit over here. So as long as it's here or keeps going higher, then it's a winner. Here, if it just tanks and keeps going down, you know, then you're stopped out at a $97 loss over here. And that's what the payout diagram looks like really quick. Was that his question, just to draw it?
Yeah, he just wanted to see it.
Okay. So that's, again, that's a vertical put spread. We just drew it really quickly. Now let's just say you have a different opinion. You're like, you know what? I don't like this spot price. I want to move this down. So I make, you know, so it's still profitable along the down here. So let's move both these strikes lower. So as you can see here, I'm going to move these down. So they're going to be more out of the money, right? So you see how I'm doing it down. So now it's 50. Now I'm selling the 59 put and buying the 57 put. So you're going to see this whole thing shift. Let's do that. Load strategy. So you see how this whole thing shifted now? Now we're making money if the stock price is right at you know, at where it is now at expiration. And even if it goes a little bit lower, we're still making money, the $60. We're getting less credit. Here's the midpoint, but the range of prices that the possibilities where we're profitable has increased. Okay, so that's what I did. So I just lowered it. Let's lower it more. Load that strategy. And you see that I just expanded the range of prices that are possible to be profitable, but I'm getting less credit and my downside is increasing if it really crashes. Now, let's just say I'm going the other way and I'm very bullish, so I don't mind picking those strikes higher. So I'm going to go higher, and I don't mind losing here because I think it's very bullish, but I want to make more to the upside. So I'm increasing it. See here, 62.60. This whole thing is going to shift the other way. So let's do that. So you could see here, now you see it has to increase. The stock has to increase from our current price for it to be profitable. But on the upside, I'm making much more now, $142 if it's up here. And I'm losing less down here. So you see what I did? Just shifted it based on two different outlooks. One, you know, I'm very bullish. I don't mind taking some more risk, or I'm not so bullish. I want to take less risk and profit from a wider range of possibilities. So that's really quickly how you could do it from here. Now, I'm not sure if we should do a ratio spread or maybe just stop here and let people, you know, play around with it.
Yeah, I mean, listen, we have from now till the end of time to have webinars. I mean, Mike was saying he wants another webinar about you know, what you did with the Theo and the win rates. He you know,
Yeah.
Mike's been a customer for a long time. He wants to walk through that.
Yeah. Yeah, which becomes it's a different part of the puzzle, right? So then you have your theoretical values and your win rate, and then you're just comparing instead of your payout diagrams, which are showing you your potential risks and reward.
Yeah, and we had Mike was asking about a calendar, you know, doing a calendar spread, and adjusting the vols. That seems like to, you know, if you want to take advantage for vol crush, that seems like that may be another episode too.
Right, and we could do this. So the thing with the and we could draw it here. So the thing is with the calendar spread is over here. We'll take September 25th expiration. So that's 9 trading days to go. So let's say we bought a call here, right? So we're buying a call in one expiration month. And let's say we go out to October 2nd. So now we're going cross expiration. And let's say we sell the call at 185. Now here it becomes tricky again, just like we we're talking about before, because September 25th, this option will expire, right? But the October 2nd option will not expire yet. It's going to continue, till October 2nd. So one of them, it's either going to be in the money or out of the money, and it's done. It's either going to convert to stock or it's going to be worthless. But this option over here, October 2nd, that's going to continue to exist past September 25th expiration to October 2nd. So you can't really draw a payout diagram exactly. What you have to do is make an assumption. So all we know is on September 25th, this option will be either on September 25th, this option at expiration will either be in the money or out of the money. It'll be either worth something or worthless. And this option, we're going to have to estimate what we think it will be worth on September 25th expiration. So I'm going to load that strategy. And again, this is what it looks like on September 25th expiration, right? Here's September 25th expiration, assuming that the option on October 2nd, it will decay, but maintain the same implied volatility of 35. So it's rerunning the Black-Scholes model, saying that what will this option be worth on September 25th if the implied volatility remains the same.
Now,
So
his thesis is that volatility is going to come in. So can he see, you can adjust that vol, right, to see what the payout diagram would look like if the vol went to, like, say 25?
Yeah. So let's just say you think that this implied volatility doesn't matter because it's all going to zero right at that expiration. So this is the implied volatility. You have to make an assumption. So let's just say you think it's going to, or probably should have just typed it in. But let's say, what did you say, Will, 25?
I just took 10.
So let's say you think it's going to be 25. Well, this will look better because, right, you're short Vega. You sold Vega. So let's reload that strategy. So you see now this deep part, the red part, narrowed in. So now you're making money closer, much quicker. So this red part was wider, now it's deeper. So if this goes to zero, then you're really good, right? So if it goes to zero, you're profitable everywhere, basically. Well, Black-Scholes doesn't know zero. So let's just say.
Well, I don't think the markets know zero either.
So look like that. It falls to 2. It's profitable everywhere because you basically just received, the entire credit. It's like they both expired at the same time. So here you're short Vega. So you're really betting that volatility, implied volatility, will start coming in. Let's go back to 25. And that's your calendar spread. Again, you have to make an assumption what this option will be worth when this option expires. There's no other way to do it. So hopefully that helps answer the calendar spread.
Yeah, that was great. You want to get a couple more questions in? How you feeling?
Sure. Yeah. I'll just leave it open for questions.
Wayne is asking, and this goes back to our Timber Hill days with me. I mean, my guess it's a box, but he's looking at buying a call debit spread and selling at the same time a credit put spread. If you did that at the same strikes, isn't that a box?
Yeah, I think so. If that's what he's saying. So what is he saying? Like a call spread like this?
He's asking what is buying a call debit spread and at the same time selling a credit put spread on the same stock.
On the same stock, but on the same exact strikes, or
he doesn't say.
So it depends on which strikes.
Not. If it was the same strikes, it would be a box, correct?
Right. So maybe he's saying, like, I'm going to get long. So this is kind of like a double long. So you see here, I'm buying a call spread. So
well, he could be trying, I guess, to, pay for his debit spread by selling a put spread. It's kind of like a risk reversal.
Right. So I think it's like a double long. They refer to it as a double long. So what I'm doing is I'm buying a call spread, but I have to pay 63 cents. And let's just say I'm bullish. I don't think it's really going to go below 158. So I'm going to sell the 158 put, and let's just say I'm going to buy this for 50 cents, the 55.5 put, just in case I'm wrong. I need to stop myself out somewhere. So what I did was I bought a call spread. So I bought a dollar call spread here. So buying the October 2nd 59 call, selling the October 2nd expiration 60 call. Then to finance that call spread, I sold the 58 put and bought the 55.5 put. So I bought a call spread, sold a put spread. Let's take a look, load that strategy. So that's what it looks like. So I'm only paying 7 cents for it, right? If it goes up here, I'm making 93 cents, but if it crashes through, remember I sold that put spread, then I'm losing 54 bucks. So I just randomly picked it, but of course you could start playing around with it, maybe even expand this instead of the 60 call. Let's say the 65 call. So that will look a little bit different. And kind of put it into the range where you think it fits your outlook. But again, you know, that's right. So that's a double long. Okay, so that's buying a call spread, financing, trying to finance some of it with selling a put spread. Here, I'm going to put, you could do like an out of the money call spread. Let's see if that looks better. So this would be an out of the money call spread and an out of the money put spread. So you can see here, it takes a big bump out here. If it falls out here where your put spread. So I think that's referred to as a double long. But yeah, thank you for bringing it up. Forgot about that.
Cool
Strategy.
All right, dude, we're touching 650.
Okay, so if there's no more questions,
well, they're questions, but they're wrapped around other parts of the chameleon. We were kind of keep this pretty specific.
Yeah, to the payout diagram. If nothing on a payout diagram, then plus it's my wife's birthday. I'm taking her out to dinner. So if nothing, nothing specifically on a payout diagram.
So restaurants in Philadelphia are open. You can actually take your bride out to dinner.
Yeah, like we could go there's outdoor seating, so you could still get outdoors. I think actually they started indoor too.
Oh, that's great.
So yeah, we did make reservations. So I think that they do have some limited indoor seating too, but definitely they do have outdoor.
All right. Well, listen, everyone, thanks for joining us. Thanks for being part of the Chameleon community. Join us every morning during the trading week on the pre-market show. We get going about 8:55. Any parting words for this crowd, Dima?
Yeah, no, thank you for joining us. Thank you for all the questions. Hopefully we see you guys tomorrow on our pre-market show. Have a great night.
All right. Stay safe, everyone. We'll see you in the morning.
Thanks, everyone.
Bye.
Bye.